So the carry trade is what drove the market for the first half of 2007 and all of 2006. It was a beautiful thing. Every hedge fund manager was heavy in this carry trade. And it's based on interest rates, okay? They're long-term trades, and you're after the interest, okay? So what you want to do is you look at the differential. You want to take cheap money, and then you want to take the cheap money, borrow as much cheap money as possible, and put it somewhere where they're going to pay you a high return on investment for that money. So you're just borrowing cheap and parking it somewhere and earning some interest, right? And because it's long-term, you want to watch the longer-term charts. So hedge fund managers love the 4-hour chart. They love 4-hour candles, okay? Because they want to hold it for a long period of time. So let's look at last year versus now, okay? Check it out. Interest rates in New Zealand, 8.25%. Wow, huh? Australia last year, 6.5%. The UK, 5.75%. Canada, 4.50%. And Japan, 0.5%. How many people here have a mortgage at 0.5%? Yeah, that's cheap money, huh? Wouldn't that be nice? Well, that's where hedge fund managers were loading the boat with that cheap money. Because for a while there, it was free. Free money. Anybody like free money? That's what was going on. So they were borrowing as much of that free money or that super cheap money, and they were just plowing it wherever they got high interest rates. And they just sat on it for years. It was phenomenal. And I'll show you what they ended up doing and then what's happened because of these things. Now take a look at today. Look at that. The New Zealand interest rate is exactly the same. Australia is higher than it used to be. And pretty much everyone else is lower. The United States certainly lowering interest rates, huh? Whew. Unbelievable stuff. Even Canada. Canada's lowering interest rates. The UK is lowering interest rates. Japan, well, they can't do anything about the currency value anyway, so they're just going to leave it there. Okay? So some values have stayed the same. Some have gone up. Some have fallen. We can take advantage of that. And I'll show you how it actually changed the market. So let's go back. Let me just show you the basics of a carry trade and why the hedge funds were doing it. Basically, you would every time you pull the trigger with your Forex broker, you'll actually earn some interest or you'll have to pay some interest at the end of the day. Because you're borrowing money. Remember that leverage? Every time you put one standard lot, you're actually not putting $1,000 of your real money. You're putting in $100,000, right? So you borrowed 100 to 1. Some of you guys are borrowing even more. So the bottom line is that if you look at the Kiwi dollar down here, 6 months ago it was paying $10.55 per lot per day. Okay? Not huge money, right? But let's change the way that you think about it. Let's think long term, because you don't care about $10 a day, right? Well, look at this. If you just held it for a year, $10 a day, $3,850.75 is what you would have earned if you held it for a year. You never made a pip. Let's say on your 1-year anniversary of the trade, it came down and knocked you out at break even pip-wise. You made 0 pips. But in interest, $3,850.75 in interest. Well, that's not bad, because that one lot that you purchased was only $1,000 of your actual money. But you earned interest on the $100,000 for a year. So your actual return on investment is 385%. Now that's pretty serious money, right? So imagine if you're a hedge fund manager doing that several billion times over, right? Now it gets pretty interesting. But at the end of the day, you probably made some pips too. And let me tell you, the interest is pathetic compared to the pips. But these guys are locking and loading based on the interest. So here's what they did: is they used the longer-term charts. They look for momentum changes on pullbacks, and then as soon as they're in the market, they're trying to get their stop loss to break even as possible because they want to take the risk off the table and just sit there and earn the interest. That's it, for as long as possible. Set it and forget it attitude.